Welcome back, everyone. We have 2 more sessions before we wrap up for today. Firstly, bring in some really interesting perspectives from both Europe and Africa. Let's take a look at the Sustainable Development Goals. To begin, I'll hand over to our session moderator, Simon Whistler.
Thank you very much, Susanna. Hello, everyone, and welcome to this session on the Sustainable Development Goals, turning good intentions into good practice. My name is Simon Whistler, and I lead the PRI's work on real assets. Our team's work focuses on how real assets investors understand and integrate ESG factors within their investment processes, and now increasingly on how they consider, act, and report on their real-world outcomes. And when we think about real-world outcomes, we think most specifically about the Sustainable Development Goals. 2020 has been an important year for the SDGs. It has marked the start of the so-called decade of delivery for the SDGs, the start of 10 years to make real progress towards achieving the goals around the world. Clearly, the COVID-19 situation has been a mixed blessing in this regard. Progress towards goals such as poverty reduction and gender equality have been hit by the repercussions of the pandemic. But on the other hand, the pandemic has concentrated on the attention on the SDGs, including from investors, far more intensely than before. This year, for example, over 600 PRI signatories reported they have some investment activities focused on the SDGs, representing over 30% of our reporting signatories. This number will only continue to rise in the years ahead. And so our discussion today aims to support investors as they look to develop and enhance their actions on the SDGs. It will be built in part around the outline of the PRI's 5-part framework for investors who want to contribute to the SDGs, and the discussion paper looking at the role of infrastructure investors in contributing to the SDGs, both published this year and available on the PRI website. For the discussion, I'm joined today by Chinua Azubike, Chief Executive Officer of Infracredit, based in Lagos, Héléna Charrier, Deputy Head for Group Sustainability at Caisse, Dépôts et Consignations, CDC, based in Paris, and Martin Ewald, Managing Director and Head of the Impact Investment Team at Allianz Global Investors, based in London. Welcome to you all, and thank you for joining us today. Before we get started on the discussion, I should just say, if you have any questions for me or the panelists, then please submit them via the Q&A tab on your screen at any time during the session, and we'll do our best to get around to as many as we can during the discussion. So to kick off, the first elements of the PRI's 5-part framework discuss the need for investors to identify outcomes, particularly the unintended positive and negative outcomes of their investments, and also to set policies and targets in a way that enable them to shape those outcomes. So I wanted to come to you first, Héléna, in particular, and start the discussion around those points. And thinking about, in particular, how has CDC built the SDGs into its policies and strategies, and how has that helped you identify your SDG outcomes as an organization?
Thank you, Simon, for this very, very good question, and I'm happy to be here today. So for those of you who don't know Caisse des Dépôts, we're the largest French public investor, and we're a public bank for local authorities and corporates, notably SMEs, French SMEs. We're also an asset manager for public pensions and retail regulated savings. And we also hold large strategic stakes in companies that are important for the French territories. So I would say that our business units and subsidiaries cover a large spectrum from return-oriented to impact-oriented, and we've had to take into account this significant diversity in our activities to develop our SDG framework. So the aim of that framework was really to assess and then increase the contribution of all these business units to the SDGs. And that is going to help our executive committee better pilot how all these business units support our new corporate mission, which is to reduce social and territorial inequalities. And the other goal of this particular project is to use the project to better articulate our financial, our strategic, and our sustainability management processes. So, for instance, one of the goals is to ensure that our strategic planning, our responsible investment policy, our climate roadmap, and our non-financial reporting are all better tied together. And so to do that, we have sequenced the work in 3 steps. And the first one is, of course, to define what we should aim for. That is to say, what should be our priority SDG contribution. And to do that, we've developed a materiality analysis with all our business units to assess their own impact on every single SDG target, whether it be positive, but also negative impact, which, as you said, is something, of course, that is less pleasant to do. And so building on that very significant analysis, each business units and our executive committee have come up with their own balance card, which is really an action plan to improve their contribution. And that contribution is really, again, either increase the positive impact or reduce the negative impact around 7 priority SDGs and 5 material SDGs.
Great. Thank you, Héléna. We'll come on to some of the points around kind of how you sort of start putting that framework into practice a little later. I want to follow up next with Martin, because as I understand it, Allianz GI has sort of made the decision to do this more at a kind of individual fund level rather than kind of across the group. And it's just interesting kind of in the decision making behind that process and how you've sought buy-in, let's say internally across the organization for working on the SDGs.
Maybe to give a bit of background, also like where my answer comes from. So my job is in Allianz Global Investors, which is the asset management arm of Allianz Group, and I'm leading the impact investments team. So what we do is we come up with funds, we implement them, we build them up, and then also we invest on their behalf. So therefore, like when we implement SDGs or impact targets on fund level, this is where how I answer things. And of course, like in a large asset manager like Allianz Global Investors, there's a broad mix of listed and unlisted. I'm on the unlisted side, and how we specifically implemented it in our latest fund is called Africa Grow, which is a blended finance vehicle as a cooperation between Allianz Global Investors, KfW in Germany, and DEG Impact. Is that we from scratch already had targeted the SDGs as something we wanted to implement. So it's not a fund where after it is already live, we implemented some SDGs as targets, but from scratch, from the first point on, this was just meant to deliver social impact on the ground. So therefore also everything starting from the strategy to the reporting to the investment targets, that all is already in line with the SDGs, of course, and requires you or us as an asset manager to also think in terms like the SDGs. So therefore, bringing it to life is, from my perspective, is easier if you have the liberty to always structure new funds rather than to implement it in large scale in a full-on organization. So therefore, we have, I guess, sometimes a bit of an easier task than Héléna actually just described it to implement on such large scale.
Great, thanks, Martin. And Chinua, how have you gone about developing your kind of, let's say, initial theory of change around for what you want to achieve with your investments in terms of the SDGs? What's been your starting point at the very least?
Thank you, Simon. So I think I'll just start by giving a context about Infracredit. We are a specialized credit enhancement facility. We're established to provide guarantees for local currency financing for infrastructure in Nigeria. Our mandate is to help mobilize long-term financing from local pension funds and insurance companies to be mobilized into insurance infrastructure assets in Nigeria. We've supported over the past 3 years over $100 million in Naira equivalent worth of financing across 4 sectors, 4 asset classes, essentially mobilizing up to 15-year financing, mobilizing the first 15-year corporate infrastructure bond to finance a hydropower project. Essentially, given the importance of Infracredit's role in providing and enabling blended finance and local currency funding for infrastructure through the debt capital markets, the debt capital market has a very important role to play. Essentially, when we look at evolving into financing the country's transition into a low carbon economy because of the long-term pool, the largest pool of long-term financing in the country. And also when it comes to infrastructure, essentially it has the greatest potential to deliver the three pillars of the SDGs on the economy, environment, and social sustainability. And recognizing this very critical role that institutions like Infracredit can essentially influence, we set out very early to define our impact framework and our theory of change, which encourages essentially a culture of accountability for data collection. But importantly is that overarchingly, it essentially helps for us to better understand our market impact, social performance, and explicit focus on development impact measurement. And to achieve this, we essentially had to put together a very much more detailed baseline indicators and reporting framework, and monitoring as well. And we also, through our theory of change, essentially, we set out our aims, which is to be very clear about what Infracredit's mission and objective is, essentially to transform the local debt capital market, to catalyze more on a long-term local currency financing for infrastructure, to essentially be able to intervene in alleviating financial bottlenecks and increasing the appetite for more financing. And in doing this, we look at it from, essentially three different pillars: from the market, project level, and the end user level. At the market level, we look at the new asset classes being generated for pension fund investors to invest in, developing new products for the market, connecting actors together. At the project level, we look at the impact it has in terms of enabling access to affordable long-term financing for infrastructure corporates that otherwise wouldn't have had access to the long-term market. But as a result of our guarantees, we enable them to have access to a market that otherwise they'd have excluded from. At the end user level, we also look at, ultimately, how does this impact on the livelihoods, on people? And we're able to measure this as well. And, essentially, the impact indicators is essentially an explicit focus on measurement and development. And that enables us to, essentially put a framework in place and an indicator prioritization that maps out against the SDG goals. And we can link that from, the pillar of our theory of change, ultimately into impact monitoring approach. So it's a journey for us, but it's very exciting, because it enables you to really understand the true mission and purpose for why you align your commercial objective into the impact framework. And also strategically, one of the things we also look at is how this helps us to catalyze more blended finance. And this is capital coming from the philanthropic and donor institutions that are looking at how best to blend capital in order to achieve impact. So this is a very interesting area for us. So we tend to look at SDG 9, SDG 17 as the anchor pillars for really mobilizing all the other SDGs, because that creates the innovation and also the collaboration that is much needed to really drive meaningful impact.
Yeah, I think it's sort of very clear in terms of kind of how everyone's developed their sort of base for action. So thank you for all of that. Héléna, I just wanted to pick up on one point that you made in your initial comments around negative outcomes. Because I think it's very easy for all of us to focus on, well, it's nice for us to talk about kind of the good stuff that we do and the good things that we achieve. When it comes to negative outcomes, just interested in kind of how have you approached those? Has it needed to be slightly different in a way to what you want to achieve on kind of more positively, or is it overall the kind of the same things, but yeah, obviously you're just minimizing your negative impact rather than focusing on the positive?
Sure, thank you, Simon. So I would say that basically there are 4 types of actions that we have included in our SDG roadmap. Some of them are about stewardship, some of them are about improved due diligence, some of them are also about increased thematic allocation, and then some of them are about in-house HR or facilities management. And so that's very schematic, but I would say that we've mostly used the due diligence and engagement levers to reduce the negative outcomes, and we've mostly used the thematic allocation to proactively contribute to positive outcomes. So very thematic, but that's the general outline to the approach.
Great, thank you. And that sort of leads us on, kind of actually sort of, you've got your, let's say, your policies and frameworks and kind of the theory of change that you want to work on. Now, sort of, actually, how do we shape these outcomes? How do we put all this into practice? So probably start with you, Chinua, sort of picking up on your kind of your theory of change and the various sort of levels in which you're trying to do things, the market, the project, the end user. How have you sort of done this on the ground? What does this actually look like when you're providing credit or working with a portfolio company? How does this actually look like in reality for the work that you're doing?
Thank you. So I think one of the advantages we have is being a locally based institution. And so, we're operating in Africa and Nigeria, and we get the opportunity to ensure that beyond just taking the baseline indicators in terms of the evidence gathering of the initial data, the monitoring of those is also very important. But we also recognize that there is also a lot of need for capacity building. And this is something we work closely with our development partners to support more training and awareness amongst the portfolio companies themselves. Because also there's a need to invest in building the necessary institutional frameworks that can enable them to build this data and report this data and understand the need for aligning with these goals. So we've actually started a process. Basic framework started with our ESG reporting framework from our ESG assessment to the action plan. But now we've incorporated into that process now the development impact, learning and measurement tools. And we've, like I said, we've had to take a dual approach of educating, building capacity, ensuring that it is institutionalized ultimately, so that it is not a tick box approach, but an approach that is well understood why they need to adopt these practices and the overall benefits of having to implement best practices in terms of ensuring that we're aligning environmental and social sustainability alongside profits.
Right. Thank you. And Martin, you mentioned your Africa Grow Fund in your opening comments, and I would imagine kind of a lot of what Gino has been talking about there with his experience is probably quite familiar to you, kind of with your work on that. I know you also have a fund that's sort of more focused on Europe, and so interesting sort of comparing and contrasting how you've managed how you manage those assets that you have within those two funds. Are the approaches the same? Are they fundamentally different in any ways?
Yeah, so really, as you just said, listening to Chinua, there are plenty of elements also we implemented in Africa Grow. So namely, we also are running a TA facility. We are a blended finance vehicle, essentially us being financed by the German Ministry of Cooperation, Bundesministerium für Zusammenarbeit via KfW. And that essentially allowed us to really shift our focus on the social impact side of things, implemented via the SDGs. Whereas in Europe, the fund we are running, the Impact Fund, that is a environmental impact fund, where we just realized that also the social impact we can generate on the ground, for example, with Africa Grow, is a very large one. In a European context, it's way more difficult also to measure and implement. So the Impact Fund for Europe, therefore, also is mostly concentrating around environmental impact, which also makes it easier to measure and report and also understand the delta you can generate. So therefore, also some of the implementation pieces we put together for Africa Grow, we just didn't need for the impact fund. On the other hand, there again, like coming back to my initial statement, we did have the liberty to structure a fund around our target to optimize impact or to have a high impact in a financial product. Also, coming back to what Chinua said, I think that's crucial. From my point of view, impact investment goes hand in hand with also the ability to generate market rate returns, which is the basis for scaling up solutions. So if you are on the market rate, you are able to attract further institutional capital. If you're not, then it's very difficult to maximize also the funds you could invest on the ground in order to optimize or to maximize the impact. And in turn, therefore, this meant for us, for the impact fund, to come up with a strategy which is aiming for environmental impact, which you can measure and report at market rates.
Okay. Can you talk a little bit about, very briefly, around kind of the metrics and the reporting that you're doing on these funds, how you develop those, and what's sort of the plans there?
Mm-hmm. So for Africa Grow, we closely work together with Deutsche Entwicklungsgesellschaft, applying their tool DERA, which is essentially really going as deep as on asset level to really come back with the social impact KPIs, including jobs created, local taxes paid. So it's a quite rich dashboard we then operate and implement. For the impact fund, what we usually do is we take the SDGs as a funnel. So we start on concentrating into assets only which generate impact. We have a look into which kind of SDGs they then cover. But for us also here, the important part really is the measuring of the KPI and also the reporting back to our investors. Quite often that is in the environmental space then topics related to carbon. So that would be either carbon avoidance in production of goods or methane avoidance or other sorts of avoided carbon, which then we will report back to our investors, and in turn they can then plug into their sustainable reporting.
Great. And Héléna, as you've gone further into the SDGs and thinking about real world outcomes through your investments, what tools and frameworks have you found helpful to support your efforts, or have you found it easier, better to develop your own methodologies for this?
Sure. So I think we've heavily relied on work that was already produced by other institutions. So, for instance, there is a very significant guidelines that have been published by the Global Compact for companies. So we found them very helpful. We've also heavily relied on the IFC principles for impact management. We've also used the GIN IRIS indicator base to select amongst the indicators. So really, we've been drawing from many different useful productions and networks and guides. But what we've been trying to do is that because it's hard for business units to navigate amongst all those different referential, we've tried to develop our own simple synthesis to explain those concepts to really operational front office teams. And so we've come up with our own internal impact framework, which is a very much simplified version of everything that exists out there.
No, that's great. And actually, I want to carry on that for a moment, because sort of if we think about the final stages of the 5-part framework that we've developed, it's very much about working together to achieve the SDGs. So that's whether working together internally through the different teams internally, whether it's working with other players in the financial system, or frankly, a broader array of stakeholders, your governments, NGOs, communities, corporates, et cetera, et cetera. So so when it's come to your work at CDC, you said a lot of this work has had to be internal. You develop your own impact management framework, but also around training and development of your own internal capabilities. So just interested in hearing some insights and how you've developed that to try and get everyone pulling in the same direction.
Sure. So we've basically enrolled some of the divisions into large training schemes on the SDGs. So, for instance, all the asset management teams have undergone a specific SDG training, so the entire division. And then we've also had more dedicated trainings on some specific themes that were a bit newer to us. So, for instance, on biodiversity, we felt that we lacked some of the internal capacities to correctly treat the subject, and so we've made a special training effort to target that SDG. Another point that I could mention in terms of interacting with stakeholders is that we've tried to build our own action plan while the French state was developing its national SDG roadmap, which was, I think, very helpful in the way that it helped us feed into that roadmap, but also the national roadmap include our own contribution. So I think that's, that was a helpful interaction with a different set of stakeholders besides our clients and companies that we reach out to.
Right. Thank you. Martin and Chinua, I've got some similar questions for you both. I think I'll come to you, Martin, first. Just interesting, some of the key lessons, let's say, that you've learned when developing your impact funds in terms of knowing your limits, in terms of what you can achieve personally and also through your organization, and the need to bring in external expertise to deliver particular outcomes. You've talked about some of your development partners. So just interested in hearing a little bit more about how and why you've gone down the route that you have done from that point of view.
Yeah, I like the question. So with regards to maybe like the measurability also of targets for the impact fund, we in the beginning also were trying to, for example, find like one unique or like one unifying KPI maybe, which then would be something we could report across all of the bits and pieces, which this is something which currently just doesn't fly. So therefore, like an impact reporting will, the way we see it, will have to deal with several KPIs, which then in turn would be something for longer run also, like one of the tasks with PRI to unify maybe a bit of the approach, how to handle with different KPIs. And I think this is also something where in our infrastructure work stream at the PRI, we do have quite some conversations about. And maybe on the other part where you really see that you have to be cautious about what is possible to implement to exemplify in Africa Grow. Investing out of Europe in times, and you started also mentioning the COVID crisis, like those, it's very important to navigate on the ground and to really understand with whom you have to partner up with like how to run transactions, what you can do remotely, what you can't. And this was something, especially in times right now where you can't really travel. You really notify that it's important to team up with the right partners. In our case, we did that. We worked together with Deutsche Entwicklungsgesellschaft, DEG Impact, in order to really have that sort of cooperational effort. And I think times like those really show that having the SDGs as an aligned target really would, the call for action would be really to team up in order to really find ways on how to operate investments with a purpose and with an impact.
And Chinua, just a sort of final question from me. I mean, you've talked about working together with, let's say, external foreign partners on some of your projects. But how important is it for you to also, you mentioned at the start, developing a local sustainable ecosystem, whether it's on the finance sector side or local companies who work around the SDGs? I'm thinking not just in Nigeria, but also sort of within Africa as a whole.
Thank you. So you very, very good question, because the process for us was, first of all, sort of gathering the existing template frameworks that we obtained through engagement with our development partners, but very quickly working with local partners to tailor these frameworks to to be able to be practically implemented. And we've done that working with both international and local, to ensure that there's a blend of experience, and ensuring that the integrity of the process in terms of the gather dataing, the monitoring requirements, testing and the evaluations, and the extent to which our activities can lead to intended outcomes, is well articulated and is implemented. And so it's a journey for us. So there's a lot of learning and engagement. And from an ecosystem standpoint, we also recognize the importance of, because of the development role Infracredit is playing with helping to mobilize domestic credit from local pension funds and insurance companies. We've extended the capacity building program to working with the investors. So we do hold trainings, engagements with the local pension funds and the insurance companies. We've even had an opportunity to do one with PRI, where we're trying to make get the investors to better understand the need to incorporate into their investment decision making the principles for responsible investment and the SDG goals. I think once the ecosystem is also very well aligned, then you have the sort of demand for more accountability when it comes to impact and the SDGs, not just coming from the intermediaries, but from the investors as well. So we've started this process, and we're looking forward to working more with our partners to begin to engender more understanding and behavioral change, in the market. But typically this starts inside. So we've also set out to improve, internally the organizational culture within Infracredit. So ensuring that, even from the transactors to the originators and the executors within the team that are involved in deal structuring and also on the portfolio management side, that there's a good and in-depth understanding of what we set out as a mission and how we intend to go about our implementing the impact framework. And that is taking a lot of, I'll say, very fascinating, having to see the team evolve their thinking and also be more purpose-driven in terms of how they see the business. And also, seeing that also evolve from both an internally driven motive to getting the portfolio companies aligned in that way, and ultimately the investors. So it's a process. But like I did say, we're very keen on ensuring that we engender more partnerships, more technical assistance and support towards these goals, and developing templates that are replicable. So, being able to replicate this in other African countries is quite easy, and not very easy, but it's easier to the extent that we have experiences that we can share, and we're happy to share these experiences with our partners.
Fantastic, thank you. So I'm going to turn to a few questions from the audience now, and maybe just a quick fire, try and make the answers sort of quick fire so we can fit in as many as we can before the end of the session. I'm going to turn to you, Héléna, first. Probably a couple that get your reflections on. First of all, Héléna, what was your data basis and the methodology for assessing SDG impact? And also, very quick thoughts on the most efficient portfolio diversification strategies to leverage for sustainable impact.
Okay, so short responses. We used our own internal methodology to assess the impact. So we built it in-house. No external database, no nothing. It's in-house methodology. In terms of portfolio diversification, I don't have a financial response to that, but that's certainly been included in the asset allocation reflection that we have had. So, for instance, we've tried to make specific commitments in terms of asset allocation for green projects. Of course, Martin mentioned those in Europe, but we've also tried a lot to develop allocations to social themes. So, for instance, work around underprivileged areas, work around access in low density areas, poor areas across France, access to public service, access to network. And so I would say that even in terms of themes and sectors, we have achieved this diversification.
Thank you. Chinua, a question for you. For Africa, one of the main challenges is around the lack of data in Africa. And the question, how are you tackling this? How are you trying to overcome this?
Thank you very much. So you're absolutely right. And I think it was the very first challenge that confronts you when you attempt to begin to be more honest about how you have impact. And I think for us, we realized we had to invest in research. We had to invest in building the data, market data. So we've done that. We've actually commissioned some research work, but at the same time, we also begin to generate data from our portfolio companies as well. So we've done it on a two-pronged approach. One is, commissioning market data, and then also ensuring that we put in a systematic way of getting the data from our portfolio companies as well. So it's a process, and the more we get the data, the more interesting it tells us more in terms of what we should be thinking strategically, what we can do to have more impact. One of the very high level points we observe is, and it's not just a Nigerian challenge. I imagine it's an African challenge. A lot of countries, less developed countries, do have this constraints in terms of when you look at the macroeconomic constraints, either high inflation environment, some have high interest rate environment, and then the currency challenge in terms of financing assets in local versus foreign currency. And then when you balance that against the capital cost and the amortization profile for the debt or whatever capital is being used to finance that asset, then you have to look at the sustainability of the tariff or the willingness and ability to pay. Then when you go to the end user and you're trying to measure impact and you're looking at those who are underserved or need to have access, then you really need to understand better what type of capital structures can finance sustainable investments that can have impact. And this is where it takes us to begin to spend a bit more of our time in better understanding blended finance, or unlocking more blended finance, because one of the sustainable paths to helping bridge the gap between sources of capital and access is being able to work with other financiers or investors within the value chain, the impact investors willing to play a role in blending the cost and to enable more projects sustainably to get to market. So this is something that has helped us better to looking at when we talk about diversifying portfolios to focus on certain sectors that require blended finance. We can create the right type of project structures, financing structures, and engage the right type of investors that can work alongside local investors to share risk in a very effective way.
Great. Martin, one for you in terms of what is your opinion on the reduction of negative outcomes being presented or sold by companies and investors as SDG impact?
That's also like one which I should answer in a minute and would require like a day. I guess in general, what we really need to be cautious as like an industry, as investors, as investees, is that like all those labels we currently see are not misused. And I think all of us, having been around like in the industry for quite a while, really see that like this will fire back. So therefore, also I'm convinced that for all of those who really mean it, who want to measure, want to report, want to be transparent, there will be a bright future. But I think it's really crucial to take it very serious and not just for the sake of like short-term gains by any sort of means, really like plug some labeling on product solutions or ideas.
Great, thank you. And I think with that, we'll close the discussion. It leaves me to say thank you very much to my panelists today. It's been an excellent discussion. I think we've learned plenty. If I could take sort of three things away, it'd be into having an internal purpose, bringing in external expertise when you need it, and also just get started. I think it's time that everyone gets started on this, and we'll learn as we go along. So again, thank you very much to our panelists. Thank you to the audience for your questions.